Hello financial fans, welcome back to another stock analysis. Today we'll be covering AbbVie, stock ticker ABBV. AbbVie is a pharmaceutical company that specializes in the discovery, development and commercialization of innovative pharmaceutical products. The company was founded in 2013 and is headquartered in North Chicago, Illinois. AbbVie focuses on the development of treatments for a range of serious and complex medical conditions including immunology, oncology, neuroscience and virology. Some of the company's most well-known products include Humira, a treatment for autoimmune diseases, and Imbruvica, a treatment for certain types of blood cancers. In addition to its focus of the new development of products, AbbVie is also committed to improving access to care for patients around the world through programs and initiatives aimed at increasing patient access to its products and therapies. AbbVie is a publicly traded company and its products are sold in over 170 countries worldwide. They currently are sitting at a $269.6 billion market cap, and in 2022 they generated a revenue of $58.1 billion, and the dividend yield is currently sitting at 3.85%. 77% of their revenue is generated through the United States, and the remaining 23% international. To determine the final valuation of the company, we'll be using a margin of safety, and this margin of safety will be based on the financial ratios, the financial health and the growth of the company, and we'll be using a standard margin of safety of 25%, which can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, bright green, or light green rather, will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from a margin of safety. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up, going from $6 billion in 2013 to $22.5 billion in 2022. The average EBIT growth during this period was 17.1%, meaning a 5% deduction from a margin of safety. The margin has also increased, going from 32% in 2013 to 39% in 2022. The average margin growth was 3.6%, meaning another 5% deduction from a margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have gone up, going from $1.60 a share in 2013 to $5.92 a share annually in 2023, which is projected as their next dividend hike. Average growth in dividends during this period was 14.6%, meaning another 10% deduction from a margin of safety. This with a high payout ratio that is currently 86.1%, which is a 5% increase in our margin of safety. The final two ratios that we'll be looking at are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. And for AbbVie, this is just over 2 years, in this case a 215% debt to EBITDA ratio, which means no change in the margin of safety. The return on invested capital is 13.1% for AbbVie, which is a 5% deduction from a margin of safety. Looking pretty good so far for AbbVie. Let's go look at the valuation models next to determine the intrinsic value of the company. The first model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2012 to 2021. The average growth in free cash flow annually during this period was 24.5%, and I'm projecting an expected growth rate in free cash flow annually of 7% over the next 10 years. With this percentage, we can determine the future free cash flow for AbbVie and determine a terminal year valuation using a perpetual growth rate of 3% and a discount rate of 9%. This gives us a sum of free cash flow of $473.7 billion, and to get our equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $406.9 billion. All that's left to do to get our discounted cash flow price per share is divided by the amount of shares outstanding, leaving us with a price per share of $229.90, which is just over a 50% upside out of this model. The second model that we use is the dividend discount model. I've imported the dividend payouts from the past 5 years, and the average growth rate annually in dividends during this period was 8.47%. I'm expecting a growth rate in dividends for the future of 6% and will once again be using a discount rate of 9% in this valuation. And this leaves us with a dividend discount model price per share of $209.17, which is a 37.5% upside out of this model. The third model we'll be using is Graham's revised valuation formula. In this model, we look at the earnings per share that AbbVie is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds. And we go by the theory that the PE of a company with no growth is 7. Looking at all of these metrics, you get a fair value out of this model of $59.67, which is almost a 61% downside out of this model. Keep in mind that this is a very conservative model invented by Benjamin Graham, a legendary investor. The fourth model that we use is the multiple valuation. In this model, we look at similar companies to AbbVie, look at their stock price and their earnings per share to determine the average PE multiple in the industry, which in this case is 25.91. All it's left to do to get a fair value is to multiply by the earnings per share that AbbVie is generating, which is $6.63 a share. And this leaves us with a fair value of $171.82, which is exactly a 13% upside out of this model. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its means. And the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years, and the average yield during this period was 4.05%, and the current yield is 3.89%. This means it's slightly overvalued rather, looking at this metric. With the PE ratio, the average PE multiple of the past 5 years was 24.22, and the current PE ratio is 22.93, meaning that it's currently a little bit undervalued, looking at this model. This is why the fair value is very close to the current price. And the fair value is $153.31, which is almost a 1% upside, so it's very close to the mean as of this model. Let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported the discounted cash flow, the discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory prices per share, leaving us with an average of $164.77. We have determined our margin of safety earlier using the standard margin of safety of 25%, deducting it by 5% for the EBIT growth, another 5% for the margin growth, another 5% for the return on invested capital, and deducting another 10% for the dividend growth, and adding 5% for the high payout ratio, leaving us with a margin of safety of 5%. And applying this margin of safety, we get a fair value of $156.53. And with the current price of $152.05, we get a small upside of 3%, meaning that it's very close to its fair value currently. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.